Okay, colleagues, so today we're going to take a look at whether deferring taxes makes sense and under what circumstances. And feel fortunate to be sharing my screen with some people who know things about that. So hopefully you'll have some ways to improve this analysis or perhaps even find some holes in my logic. I really find this a fascinating topic. So if I start cursing or spitting at the screen, please forgive me. But fundamentally, it's a really interesting thing, and many people, especially in the corporate world, face this if you have access to a 401k, whether traditional or Roth, or perhaps you have access to an IRA, and again, whether traditional or Roth, and it becomes kind of an interesting decision on where should I save my money based solely on tax consequences. And let me hasten to say, I am not a tax expert. I'm not a personal finance expert. I have no initials after my name other than, Mr. And I'm not a lawyer. So just a practitioner. And second, here we're looking at it solely from the perspective of numbers. We're not thinking about inheritance, transferring things to your kids, anything like that, strictly numbers. So fundamentally, we're looking at one main question and then some variations of that. And does deferring taxes make sense? And really, we're just going to compare mostly a traditional 401k to a Roth 401k. And as you folks probably know, a Roth 401k allows you to pay taxes up front on the principal, but then everything grows tax-free after that. So when you withdraw it, there's no additional tax. Whereas with the traditional tax shelter instruments, you are deferring those taxes, or in the case of an IRA, perhaps you're getting a tax deduction in the year you take it, but then downstream, when you withdraw, you're paying taxes both on the principal and on the earnings. And it becomes kind of a fun question, and you hear this a lot from practitioners. They'll say, well, defer taxes because you're going to be in a lower tax bracket in retirement. And that could be true, but we don't really know what the rates are going to be. We don't know what the brackets are going to be. We don't know what the deductions are going to be, because it's going to be a guessing game, right? And so let's just start with this basic question. If tax rates remain constant, so say ordinary income tax, you're paying 20% now, you're going to be paying 20% in 20 years, are you better off getting a Roth where you only have to pay taxes on the principal, or a traditional where you're going to be paying taxes later on both the principal and on all the earnings? It's kind of an interesting question to me. And so we have a bunch of inputs in here, and these aren't so important other than we'll look at keeping tax rates constant. We'll also take a quick look at what if tax rates go down in the future, probably unlikely given what we know. What if tax rates go up in the future? And we'll also take a quick look at, hey, what if I took the money out and I put it in something that's like I'm buying Amazon stock, and 20 years from now, I'm going to have no dividends, no interest. I'm going to cash out 20 years from now, and I'll be in the 15% long-term capital gains rate bracket. So we just build a model down here to do this. And I'm not going to go through this because it would just kill everybody. But when we look at sort of the traditional model, we start with some principal. And I do year zero just to have things clean when we do the Roth. We've got some principal. We earn 7%, and this just accrues year after year after year with no tax until we get to the final year. We do a withdrawal using a 20% tax rate, leaving us with this sum. Likewise, and this to me is kind of an interesting thing, with the Roth, we have to pay that 20% tax up front, right? So in year zero, right as we're putting the money into the account, we pay 20% tax. And so rather than having 10K to work with this principal, we're left with 8K, but it's after tax. And a similar thing occurs. Each year we have some earnings, no tax occurs. And then in the final year, once again, we've already prepaid the tax. What to me is fascinating is both of these produce exactly the same result. And so this is the key thing. If anything else, please walk out with this notion. If tax rates are constant, it doesn't matter if you pay the taxes in the beginning or at the end, you get exactly the same result. I find this utterly fascinating. I like it quite a bit. And here's a chart that sort of shows the intuition graphically. So we've got the traditional at the top, we've got the Roth at the bottom, the green dotted line. The Roth takes your tax haircut, so you lose $2,000 off the front, and it grows and grows and grows up to $30,957, whereas the traditional grows to a higher amount, but after you take taxes, it ends up being exactly the same amount at the end. And this is the point where I'm actually going to stop. Mark, I would appreciate your approval or disapproval of my logic and thinking on this. Thoughts, comments?
It's an interesting, so I guess go back to the table for a moment, if you don't mind.
Yes, sir.
So I guess I would be interested to do another table that took the $2,000 today and say, what would that cost me in 20 years?
Yep.
To see if I come up with the 7739.
There it is.
Oh, you already did it. Okay.
Yeah.
Yeah. So, okay.
Yeah. So I had the same intuition. I thought, I bet the future value, well,
well, it has to be. It has to work out. If the numbers work out, I get how the 10 grand grows into 30. The 2 grand growing into 7,700 is not as intuitive.
Yep, exactly right. And I think the intuition is that the tax obligation grows at the same rate as everything else. So,
well, you kept the tax rates consistent, so yes, that works.
Yep, exactly. And we do, here's something cool that Excel can do. So this looks like plain text. If we look at the formula, and I know I've covered these before, we're using the concatenation function several times, number one. So we're just pasting pieces of text and the results of some formulas together, which is fun. And so that's one thing to look at. Another is we use things like the dollar function to make sure that we're just not looking at like a string of numbers, because otherwise this would be like, I forget, but it would have several decimals. It would look really ugly. So wrapping some of your results in a dollar function or a fixed function works really well, because then when you display it like in text format or on a chart, you get something really easy to look at, easy to read. And we use cell labels, as I've discussed before, because these are kind of a nice, interesting way to look at things without having to refer to a specific cell. And so
is that the same thing as a named range?
Yes, exactly.
Yeah,
we're just naming a single cell. In fact, let me just go up and click on one of these. So here's one of them. And we look up here. So now we can refer to it. We could still continue to call it D14, but we could also call it this fancy label I came up with. This is sort of the naming convention I like to use. There's probably better ones available. Okay, so that's the first, and to me, the most critical part of this exploration.
I love your use of underscores for your spaces. Looks like a coder wrote it.
You can't have spaces in named ranges.
That's exactly right. Yeah, long ago, my undergrad degree is computer science, so that's probably part of the problem. And I also, and again, this is really important when we think about hedging against future taxes. We do the same thing, but now I picked an arbitrary lower future ordinary income tax rate and an arbitrary higher tax rate to see what would happen. And we get rid of the Roth because it produced the same results. So that 30,957 was our traditional under the current tax rate of 20%. However, if tax rates decrease in the future, and again, it's your effective tax rate based on rate, bracket, deductions, all that other stuff, obviously you're going to get a better outcome. So if you think tax rates in the future for you are going to be lower than what they are now, well, what they are now gives you 30,957. So if you think they're going to go down, you're better off waiting to pay those taxes. And conversely, and obviously, if you think tax rates are going to go up, well, your end result when you do the withdrawals is going to be a lower figure. And interestingly, with the Roth, it's consistent under all of these because future tax rates don't affect it, right? You're just paying it now, you're gambling that they're going to go down, or you want to have some flexibility with withdrawals and managing your overall tax burden. So again, another way to kind of think about this question. And then a third chart, and this is a little bit farther afield, but here we're thinking about, well, we had this traditional traditional IRA or 401k that yielded this. But what if I earned the money? I took it as income right away. So I pay the taxes. So I'm down to 8,000. And I put it into a CD. And I would certainly never encourage anybody to do this, but some people are really conservative and they might think, okay, I'm going to put it in a CD and I'm pretending it's earning 7%, same as stocks. What might that end up as? Or what if I put it into a stock, the red dotted line, where I'm generating no annual income? I'm just going to have to pay taxes at the end. So with the interesting thing here, and where this varies from the rules we first discussed, is with the CD, each year you're generating income that's taxable and you're paying taxes on it over and over and over. And so my intuition, and again, Mark, I'd appreciate your corroboration of this, it's almost like you're paying compounded taxes compared to the first two scenarios. If you pay it all up front or all at the end, it's like you're paying a simple rate. Whereas if you're paying it every single year, you're just taking a haircut year after year after year. It's almost like you're paying compound tax rates. And if I were smarter, I'd be able to put it into formulas, but I'm not. So,
Yeah.
so this would be somebody who's I certainly wouldn't advocate this if you are really, I don't know, a very, very traditional investor. You're going to be getting income each year, but it's taxed every single year. And it produces about the worst outcome of all. And here we're still using that 20% tax rate. We're just flat across the board. If you put it in a CD and you get taxed every year, you're going to take a pretty big haircut.
You're also not going to earn 7%.
Yeah, no, certainly not. And again, I just wanted to keep the comparison simple, but you're exactly right. With a fixed, with something like that, you're not going to get 7%. The other thing I thought might be fun is, well, what if maybe I filled up my limit, my contribution limit for 401ks or other sheltered devices. So I have post-tax income, but I'm going to buy stock in Amazon. It's not going to pay interest or dividends for 20 years. And then I'll just have to pay capital gains tax at the end. So I pay ordinary income tax up front on the principal. At the end, I pay long-term capital gains tax on any capital improvement I've gotten over the years. And even that ends up inferior because, again, you're kind of stuck paying taxes twice. And even though in this case, I picked somewhat arbitrarily 15% as the rate, you still end up worse off than you would being completely tax sheltered the entire time and just taking the haircut at the end. So this is
also subject to market returns,
yes,
which are nice and smooth here, but in reality aren't.
Yes, absolutely. And as someone who is very concerned at the moment about sequence of returns risk, you hit the nail exactly on the head. It's never linear and smooth in the real world. So this is a somewhat arbitrary example. Again, just trying to think through the logic of, does it make sense to defer taxes and under what circumstances? So I'm going to stop the recording right now, and we'll have a little bit of office hours time. Again, encourage everybody to go ahead and let's excel today.